Okay, let's unpack this. We are diving deep into a problem that is, um, I think it's pretty much universal for anyone trying to navigate the financial markets on their own. It's that deep frustration of having a perfect plan that you just fail to execute. We're calling it the execution gap.
And it is the single biggest point of failure. It really is. It's where intelligent people in these high-stakes environments just fall apart. You, the learner, you know the rules. You
Right.
absolutely do. You can see the trend. You know where support and resistance are. You can spot a textbook setup from a mile away. But then the entry signal fires. Real money is on the line. And what happens? You hesitate.
Oh, that hesitation is
Or
killer.
you jump in too late. Or worse, you break the one rule you swore to yourself you'd follow. And just like that, consistency is gone.
Exactly. It just vanishes. You know what to do, but the actual doing, that's where it all breaks down. Our sources for this deep dive, and it's a fascinating collection of specialized market briefings, articles on performance psychology, they all suggest something, well, something really critical. The reason most independent traders struggle isn't a failure of intelligence. It's not even a failure of strategy, which is what everyone thinks.
Right. They blame the map.
They do. But it's an execution breakdown, one that happens because the trader's environment just completely crumbles under real market pressure.
So our mission in this deep dive is to, synthesize the surprisingly simple but profoundly difficult truth about trade execution. We're going to distill those hidden decision-making patterns that sabotage even the best trade plans, and then explore a framework for consistency.
A framework that, and I love this part, relies entirely on structure, process, and environment. It moves way beyond just, trying to have more willpower.
Far beyond it.
So the ultimate question we are addressing for you is this. Why do smart traders know the golden rule, but then they bend it the moment the market gets a little bit noisy? Let's define this gap first, starting with the traditional way people think about this.
Okay, so traditionally, trading education is, well, it's an information game, right? It's all about accumulation.
More is better.
Exactly. It focuses heavily on what to learn, more indicators, more complex algorithms, mastering these incredibly intricate systems, memorizing chart patterns. And the misconception, which is really deeply ingrained, is that if you just acquire more tools or find that one perfect indicator, you will somehow, almost magically, solve your consistency problem.
I fell into that trap for years. I really did. You think, I must be missing some piece of information, some secret.
Of
So
course.
you buy another course, you add another screen to your setup, you study another obscure indicator, all thinking that more analysis will lead to better execution.
And that works perfectly fine,
Yeah.
in theory, when you're looking at a static chart after the fact.
So it's crystal clear.
It's crystal clear. You know exactly where the stop should have gone, exactly where the target was. It's easy.
But our sources, they paint a pretty painful picture of what happens when that theory meets the reality of a live, moving market. The moment real risk, real emotion gets introduced, the rational part of the trader's brain just gets hijacked.
Hijacked is the perfect word for it. They identify these really specific, recognizable symptoms of execution breakdown. The most common one is that crippling hesitation, that that sudden paralysis that makes you miss a perfect, clean entry.
You just freeze.
You freeze. Then there's the overthinking. Maybe this time is different. What if this happens? And then the worst culprit of all,
Bending the rule.
betting the rule, moving a stop loss because you're in the red, or chasing a price way past your entry point because you convinced yourself just this once. The plan was too conservative.
Ugh. That's the moment where you're two people at once. You're the rational analyst who drew the plan, and you're the impulsive, emotional actor who just completely ruined it. So why? Why does that gap, that difference between knowing what your plan requires and actually doing it, why does it stick around even after years of study?
What's fascinating here is that the materials suggest you're focusing on the wrong conflict entirely.
Okay.
The struggle isn't between your rational self and your emotional self.
Yeah.
The real struggle is between your intention and your environment, chasing a better strategy. It rarely solves these execution breakdowns. Why? Because the problem isn't the map. It's the vehicle you're using to drive the route.
So, okay, if the problem isn't finding better strategy, then what's the critical pivot? Our sources argue we need to just abandon the whole idea of relying on willpower and shift our perspective to, what? Environmental design.
This is the absolute core of it, the critical pivot. The failure, according to this deep analysis, is not a strategy problem. It is an execution environment problem. And this thesis holds true across all areas of high performance, not just trading. The environment shapes and influences behavior far more effectively, far more reliably than sheer discipline ever will.
Okay, wait, let me challenge that for a second. If we're focused only on environment, aren't we kind of ignoring the fact that some people just lack basic self-control? Can a structure, a good environment, truly override a deep-seated personality flaw or poor emotional regulation?
That's a really important question. And it's not about ignoring self-control. It's about acknowledging its limits. Willpower is finite.
It runs out.
It always runs out. Think of it this way. If you're trying to stick to a strict diet and your kitchen counter is just piled high with cookies and chips,
Yeah,
you are putting your willpower under immense strain multiple times a day,
every time you walk into the kitchen.
every single time. But if you restructure the environment, if you don't buy the cookies in the first place or you put them in a lockbox in the garage, you eliminate the daily confrontation. You make the right choice, the path of least resistance.
That makes perfect sense. So you're not fighting a battle every hour. You design the environment to demand the behavior you want, and that reduces the cognitive energy, the willpower you need for every single decision.
Absolutely. The key insight laid out in the source material is this unbreakable chain of influence. Environment shapes behavior. Behavior determines execution. And execution. Well, execution determines your results. So if you want to change the results, you can't just try to be more motivated or have more willpower. You have to fundamentally restructure the environment that surrounds the decision-making process itself.
So practically speaking, what does a powerful trading environment look like? It's not just about having 3 monitors and a fast internet connection, is it?
No, it's not about the hardware at all. It's about psychological and mechanical structure. And the sources draw a really powerful analogy here, connecting trading to other high-stakes performance jobs. They note that consistent performance always requires structure, reliable feedback, and predefined context.
Like what?
Well, athletes don't just train in isolation hoping for the best, do they? They follow rigid programs, they track their metrics, they have coaches providing external accountability.
And pilots. Pilots don't practice without simulators and detailed checklists.
Exactly. So the independent trader, sitting alone at home, is essentially asking for world-class performance without any of the infrastructure that every other high-stakes professional requires to succeed.
Wow. When you put it like that, the isolation itself is the flawed environment.
The volatility, the infinite possibilities, and the isolation. That is the flawed environment. It's an environment that's basically engineered to feed hesitation and emotional decision-making. Therefore, the conversation has to shift entirely. Instead of constantly asking, what strategy should I trade?
You should be asking.
You should be asking, what conditions and what fixed routines will help me execute consistently no matter what my mood is?
That change in framing is profound. It's huge. It redirects all that effort from the constant, exhausting process of just gathering more information to what you could call performance architecture, building a resilient, rules-based routine.
Correct. When you treat trading as a performance activity, your goal just changes completely.
It's no longer about predicting the next move.
Not at all.
Yeah.
It's no longer about seeking more tips or trying to predict where the market is going. The goal becomes operating inside a supportive, rigid environment that enables consistent, almost mechanical execution of the plan you already have.
So what are some of these tangible mechanical routines that support this consistency?
They generally fall into 3 categories that successful traders master: preparation, execution, and review.
Okay, preparation.
Preparation involves a mandatory, non-negotiable pre-market checklist. And that checklist defines the environment. For example, a rule might be, I will only trade today if the S&P 500 is trading above yesterday's high. If it's not, you don't trade. The decision is made for you.
And execution.
Execution involves non-negotiable entry and exit rules that are fired automatically when the criteria are met. This removes the need for that internal debate, that negotiation with yourself in the heat of the moment.
So the environment isn't just about the physical desk. It's about embedding these rules into the process itself so that when the trade actually happens, the emotional brain doesn't even get a vote.
Absolutely. You are externalizing the discipline. When you design the environment to demand good behavior through fixed checklists, predetermined risk, non-negotiable profit targets, you drastically reduce the need for that white-knuckle willpower, which, as we know, is always exhaustible.
You're operationalizing discipline.
You are building a system that runs itself.
The sources suggest that by shifting this perspective, you get a much clearer framework for evaluating trades without emotional interference because the structure itself forces clarity.
It does. It forces you to define what a good setup means in terms of the execution environment, not just the pattern on the chart. A setup might look beautiful, But if it doesn't fit the current market context and your preparation checklist, the environment dictates that you simply stand aside. No debate.
Okay, so this is where it gets really interesting because the source material points to a specific methodology, the NeuroTrader method, invented by Tom Winterstein, as a concrete example of how someone can actually build this kind of execution-focused environment.
Right. This patent-pending method is presented as a structural environment that's built specifically to solve this execution gap problem. The goal is to provide the structure that turns that frustrating inconsistency into consistent, repeatable execution. It's a tangible example of these theories in action.
Let's talk about the tools they use, but specifically through this lens, how do the tools reinforce the execution principle rather than just being more technical stuff to learn?
Certainly. So the methodology emphasizes a few things: specific price action foundations, market structure analysis, and a critical skill they call trade entry timing. They also use advanced targeting and sequencing based on Fibonacci tools. And there's a specific focus on what they call the 6 Fibonacci types that create the most precise price targets and reversal zones.
Okay, so the technical knowledge is clearly still important, but how does using something like, say, precise Fibonacci targets, how does that actually improve the execution part?
Great question. It's because by defining those precise targets and reversal zones using Fibonacci before the trade is even entered, the system eliminates one of the biggest emotional choice points a trader faces, which where to take profit and how much to hold on for. If your target is rigid and mathematically derived, the trader doesn't have the mental attitude to get greedy and hope for more, or to get fearful and exit way too early. The structure enforces the profitable action.
Ah, so the technical tool becomes an execution guardrail, not just another prediction indicator.
Exactly. And to reinforce that behavior, the methodology includes performance and execution conditioning, along with access to a live, structured environment they call the Insider's VIP trade room.
That live environment seems absolutely key. That's the pilot simulator, right? That's bridging the gap between theory and practice. How does that trade room specifically function to support consistent execution?
Well, its purpose is explicitly not for trading signals. It's for conditioning through observation. Members see the methodology being applied by the instructor in live market conditions. They see real-time trade planning. They see how key support and resistance zones are identified. They get analysis of price action context across major indices and stocks.
So it's not about being told what to trade. It's about observing how a disciplined person plans and implements their trade when the pressure is on.
Precisely. The focus is explicitly stated as being on preparation, discipline, and the execution process. It is not alerts, signals, or predictions. The whole goal is to condition the eye and the mind to recognize and, more importantly, to trust the rules-based approach, even as the market is throwing all this emotional interference at you. It helps the trader internalize that the process is more important than the immediate outcome of any single trade.
That observational learning environment is a form of environmental conditioning itself. You're effectively training your brain to follow a fixed routine by seeing that routine successfully implemented over and over in a high-pressure scenario.
And if we connect this all back to the bigger picture, because we're discussing environments that involve high-stakes financial activities, it is absolutely vital that we provide the critical context about risk. Transparency is a core component of any well-informed execution framework.
Agreed. We have to be crystal clear about the substantial risks that are inherent in this kind of activity.
Yes. Futures, Forex, options, virtual currency, any kind of active trading. It all contains substantial risk. It's not appropriate for everyone. There is a very real potential to lose all of your initial investment, or even more. The sources are emphatic about this. Only risk capital should ever be used. That's money that can be lost without jeopardizing your financial security or your lifestyle.
And when we're looking at any educational or simulated results, like the ones that might be discussed in that trade room, we have to remember the limitations of hypothetical performance.
This is a crucial point of context. Hypothetical performance results have inherent limitations. They're very often prepared with the benefit of hindsight, and they do not involve actual financial risk. And that lack of real risk means hypothetical results can't fully account for the psychological factors we've spent this whole deep dive discussing. The ability to withstand losses or to adhere to a trading program in spite of those losses. Those are material points that can and do adversely affect actual trading results.
So the takeaway is clear. Any actual results you might achieve could differ sharply from hypothetical results. Any trades presented, including those in the trade room, should be considered hypothetical. They should not be expected to be replicated in a live trading account. And, as always, past performance is not necessarily indicative of future results.
This required transparency ensures you approach any system, no matter how structured it is, with the critical perspective that's necessary for success.
We've covered a lot of ground here, moving from the frustrating symptoms of inconsistent trading to what our sources identify as the root cause, a flawed execution environment.
We established that the missing link for so many informed traders is not more strategy or more knowledge, it's a disciplined execution environment, a specific, resilient architecture that fundamentally mitigates the opportunities for emotional interference and supports consistency over time.
So, what does this all mean for you, the independent trader? It means you have to fundamentally shift your definition of progress. You have to stop seeking that elusive magic strategy that promises infinite returns and start treating your trading desk like a structured performance cockpit.
Exactly. The goal should be shifted from seeking more information to operating inside an environment that supports disciplined decision-making
Yeah.
and has non-negotiable execution rules.
Stop asking what you need to know and start asking how you need to operate.
That small change in framing, from information seeker to performance architect, that is the insight that can finally break the cycle of inconsistency.
And that is a powerful thought to leave with you. If environment shapes behavior and behavior determines results, think about a routine or a goal you struggle to maintain, maybe outside of finance. Perhaps it's exercise or saving money. Are you trying to fix a behavior problem with a strategy solution, like a new diet plan? Or are you maybe missing the crucial structure, the feedback loop, or the supporting context in your environment that, if you added it, would finally bridge your own gap between knowing and doing? Something to mull over until our next deep dive.